Do you have any worry that any cuts by the Fed might amplify the carry trade risk that we've seen with the yen, sort of, a stronger dollar type of effect, and just like make things work, make the things that we saw on Sunday even worse?
Well, yeah, that's a good question. Um, I mean, the Fed doesn't want financial instability, but a stock market going up 20% isn't really concerning the Fed. What concerns them is a misallocation of capital. And if capital is put into financial markets because no one wants to do CapEx or nobody wants to expand a business because the Fed might crush the economy,
Hmm.
you might we might have to think that by cutting interest rates, the Fed is essentially allowing capital to be put back into the real economy. I don't know a lot of CEOs who've been doing CapEx because why would they invest more at a time when the Fed's tight and is worried about inflation and could crush the economy? I mean, that's not the kind of environment that greenlights capital spending projects. So I think, believe it or not, it's actually has been an impediment to economic growth, but it also has amplified carry trade because you're right, people seek yield when you have an artificial high cost of money.
Tom, can you make the steelman the argument for that this wasn't a growth scare, that we are maybe in the beginning of a recessionary period of time, that things get more bearish from here? If you were asked to kind of steelman that case, what would you say?
Okay, so let's flip the hat. Um, I would say, you know what? A recession is, expansions don't die of old age. Um, they get killed by the Fed, right? So, um, so did the Fed stay tight too long and it's already killed the economy? Well, that's one way you kill an expansion. The second way, of course, is you create a shock. I mean, let's look at both, but is the economy already in a path to actually crumble? The area that's weak right now, we already know there's three areas of recession. Auto sales is in a recession. Whether it's used car prices are going to on a free fall tomorrow, we get Manheim, but used car prices have been tanking, and automakers raised prices with greedflation. Now there's inventory piling up. Auto delinquencies are up. That's in pretty bad shape. The second
Hmm.
area that's in bad shape is durable goods. I mean, people aren't buying appliances, things that installment debt. I mean, it's just too expensive. Credit card debt is, cost of credit is 25%. I mean, who's going to buy a dishwasher with those kind of costs? And the third is that housing activity is in a recession because it's prohibitively expensive to get a mortgage now, and home prices have gone up. It's not clear if they're going up because of tight supply or if it's for whatever reason, but it's gone up, and it's hard to get money. So could those three drive a recession? Absolutely. I mean, a durables recession and housing is really sometimes where you get a recession. So is housing so far gone that that is impossible to turn around by the Fed? Uh, we'll see, right? I mean, if they're worried about inflation, they could put a death spiral in that part of the economy. There's not over investment anywhere else. I mean, the stock market, like let's say someone thinks it's a bubble, it's not really what causes the recession. It's that
Hmm.
too much capital is raised in a bubble and then it's misallocated. That's what happened with the .com. And then of course there could be a shock. I mean, like what you're pointing out, is the yen carry unwind, is that a shock? I mean, that could be a shock. Is if oil supply is massively disrupted, that definitely could be a shock, right? I mean, oil could go either way. It's either going to go up a lot or down a lot, but that could create a shock too. And that could just, and that could interrupt trading of currencies. I mean, currency stability is important too. So I think it's possible that you could have a recession, but really, like, as I talk it through, I would say the housing thing, I'm not as inclined to think it's going to lead to a recession, because we know there's a lot of pent up demand. It's not like you've exhausted demand, and mortgage rates would drop as soon as the Fed starts cutting, especially adjustable rate. But could oil spike? You have to get oil to around 250, and around 250, the debts, the cost of gasoline as a percentage of household income is enough to be recessionary.
Have we
So
ever
you
seen
could cause that.
have we ever seen a growth scare like this in the past, Tom, that would be analogous? Because, like, just looking at the VIX, we see, 2008, 2020, and obviously a lot more happened after the initial, like, VIX spike. A lot of negative things, right? And it just seems weird that the market, like, the whole thing feels weird. It feels weird that the market is so on edge, so fragile, like just a little blip and then boom, the Japanese stock market is down 12%. And like, it feels like we're in a sort of a strange time. And it may be getting back to kind of the dot-com bubble, right? AI has been on an absolute tear. That could be in bubbly territory. But like, just in general, is there anything like this that we have seen in history that would be analogous?
Ryan, I want to just point out a couple things. I'm not trying to oversimplify this, but because I've been following equity markets for 31 years, 32 years actually now.
That's approximately three crypto lifetimes, I would say.
Yes, that's right. I'm like, then yeah, that means I'd have great grand crypto children.
Yes.
They say bull markets take the escalator up and the elevator down. So big corrections like this are more associated with a bull market than a bear market. In fact, if you look at '08, for instance, when that market was topping, it was bleeding and bleeding. And then it was towards the end that you were having these get me out of everything declines. Whereas this S&P was essentially fell over 3 days. I mean, the correction, might be 2 weeks, but it was just 3 days of sheer horror. And those kind of panics definitely happened. In 2018, you had the tantrum around the Fed because Powell was raising rates, and COVID created a huge decline that was quickly reversed. I mean, that was the fastest decline of 45%, I think, in history at the time, right? And as you know, the mistake people made in 2020, and we were dealing with the blowback, was everybody was like, you know what? This is the knock-on effects on the economy is just getting started, and we don't even know if how to contain this disease and how deadly it's going to be, how you're going to fix it. But the stock market bottomed in March 2020. That was 6 months before the vaccines were even out. So I think that the Fed can fix these ripples really easily, even if they just do it in September. I know it seems unusual, and it is. I mean, the stock market's been doing great. We had low volatility for 2 years, and now volatility is coming back. That's what's changed. But I think it's probably just more that this bull market is becoming a teenager,
To continue leveling up your crypto game, then you need to get on the Bankless newsletter. It's the world's most popular crypto email and is completely free. Just click below to sign up.